So welcome back to Financial Accounting 1, and I've added a new dimension to the course, and I hope this is responsive to some of the feedback that I got from you after the first exam. What I'm going to be doing now, in addition to going over the exercises in class, the in-class exercises, and posting the solutions, I'm going to actually give you a video walkthrough on each of the questions as well. So first question here has to do with inventory, and we got a company that made three purchases. And the company uses a periodic system, and they value their inventory. They've asked us to value the ending inventory under both the FIFO method and the LIFO method. Now, we've already established with our discussion of cost flow assumptions, FIFO and LIFO, if you've got the prices are increasing or prices are changing, they'll give you different answers. So the focus here is come up with the ending inventory. So in FIFO, ending inventory, and they're using a periodic system, which means we figure out the inventory at the end of the period. We don't adjust the inventory every time there's a purchase, every time there is a sale. So FIFO means first in, first out. So if it's first in, first out, when it comes to your ending inventory, it's going to be made up of your most recent costs. And it says there are 300 units on hand. And if I look back from my most recent cost, the third purchase was 400 units at 9. I've got 300 in inventory, so I take 300 times $9. That gives me 2,700 as my ending inventory. Also, they've asked us now to take the same fact pattern, but say, what would be the ending inventory if it was valued under LIFO? Now, LIFO is last in, first out, so your inventory is made up of your oldest possible costs. And if you look at your oldest possible cost there, we had 200 units at $6. Well, that doesn't give us enough. We need 300 units. So we take 200 at 6. And then we take another 100 at 7. So LIFO, we get an ending inventory of $1,900. Notice we get two different answers. Notice since prices were rising during this period, you get a higher inventory under FIFO than you do under LIFO. So since LIFO gives you a lower ending inventory, it also gives you a higher cost of goods sold, which has ramifications for the amount of taxes that we have to pay. Also has ramifications on the balance sheet and the income statement, which we'll get to in the next problem. The next exercise, rather. Exercise 2. So we reported net income of 120,000, but the ending inventory did not include $9,000 worth of goods that were consigned to Ellie's gift shop. Now we know that when we have goods out on consignment, the title does not, there still are goods, we still have title to them, so they should have been included in our ending inventory. So they ask us, what's the correct inventory for 2020? Well, before we answer that question, we have to say, what is the impact of the error that we made? So look at the cost of goods sold calculation, which I put down here below, together with the typo. Beginning inventory plus purchases gives us goods available. So if we've got the goods available, that which is not an ending inventory ends up as an expense in cost of goods sold on the income statement. So if we've underestimated the ending inventory by 9,000, that means when you subtract 9,000 from goods available, that means if the ending inventory is understated, then the cost of goods sold is overstated. And if cost of goods sold, since it's an expense, if we've overstated the cost of goods sold, we've understated the net income. So if we've understated the net income, the mistake is $9,000. So the correct net income, if we had evaluated the inventory correctly, would have been 129,000. And then they say, what is the effect of the error that we made on the balance sheet? Well, on the balance sheet, if we've understated ending inventory by 9,000, we've understated the asset inventory on the balance sheet. And since that mistake resulted in us understating net income by 9,000, we've also understated stockholders' equity. Stockholders' equity is just capital for a corporation. So on the balance sheet, by understating the ending inventory, we've understated both the assets inventory on the balance sheet, and we've understated the stockholders' equity by 9,000 as well. If that was the sole proprietorship or a partnership, we would have said we would have understated capital by 9,000. Third one, here we're looking at some measures, financial ratios having to do with inventory, and they've asked us to do two things. Get the inventory turnover, and the inventory turnover is cost of goods sold, which is given at 170,000, divided by the average inventory. So we had ending inventory of 22.6 and beginning inventory of 21.4. Get the average of those two, so 171,000 divided by the average of these two gives you 7.8. And that means the inventory turns over, or the inventory is sold 7.8 times per year. So if the inventory turns over 7.8 times per year, you want to get the days in inventory. Very complex math here. You take 365 and divide by 7.8. So they've got roughly 47 days worth of stuff in inventory. So those two numbers give you metrics that you can compare to what the company was in the past, what was their inventory turnover in the past, what was their days in inventory in the past, and you can compare it to their competitors. How does their inventory turnover compare to their competitors? So ratios themselves really don't tell you too much until you start to do some comparisons. So what comparisons do? You compare it to what it's been for the company in the past, you compare it to your competitors, you compare it to what you wanted it to be. And the fourth one, this gets more complicated now. The company is using perpetual inventory. Perpetual inventory means that you have to, when you have to account for every time you have a purchase, every time you have a sale, you've got to calculate the purchases, you've got to calculate the cost of goods sold. You don't just get to wait to the end of the period. And it is, they're using LIFO, which means that the first stuff that came in is going to end up in ending inventory, and it's our most recent cost that actually ends up in cost of goods sold. So they say, prepare a schedule to show the cost of goods sold and the value of the inventory for the month of May. So remember now, they're using LIFO inventory. So that means whenever they have to have a sale, they've got to go back and say, what is my most recent cost? And that becomes the cost of the sale. So we've got a purchase of 20 units. And in beginning inventory, we had 20 units at 6. Then we purchased 20 units at 7. So that means we had 40 units. And now we sold 12 of those units. Well, if you sell 12 of those units, what is your most recent cost? Okay, well, our most recent cost there would be, well, we had a purchase of 20 units at 7, so I sold 12. So my cost of goods sold on May 15th would be 12 units at $7. Now, if you sell 12 units at $7, that means you got 8 units left at that price when it comes time for the next sale. Then on the May 18th, we had a purchase of 10 units at $9. And now we've got to figure out what is the cost of these 18 units that were sold on May 21st. So remember, we're using last in, first out. So my cost of goods sold is made up of my most recent cost. Well, my most recent cost there would be, I don't have 18 units at a particular amount. I got 10 units at 9. So there's 10 units at 9. And I need another 8 units because I sold 8. So you go back and your next most recent cost would be those 8 units you have left over at $7. So it's 8 times 7. So my total cost of goods sold is 30 units at $230. Now that's under LIFO perpetual. And as far as the ending inventory, I got 30 units left. My 30 units left are the oldest stuff that's still sitting in inventory. And that would be my 20 units at 6. And I've got 10 units left over that I paid $10 for from this purchase. This is why we say in inventory, we have various layers. Okay, so hope you found that useful. So going forward, what I'll do is always do a little video walking through the solutions to these. And these type of questions are the things that show up. They're conceptually they're tested on the multiple choice part of the exam, number 2. But the problems tend to be similar to these things that we do in class. Okay, hope you found that useful. I look forward to your feedback.